Everyone told you the market was about to collapse. The recession was inevitable. The crash was imminent. The experts were certain. Oil spiked. Iran closed the Strait of Hormuz. Tariffs jumped. The Buffett indicator hit 220% of GDP, a level we've never seen outside of a bubble. The CAPE ratio hit 39.8, almost exactly where it was right before the dot-com crash. And yet, the S&P 500 just clawed back to its all-time high. Again, not despite the chaos, somehow through it. So I have one question for you today, and it's the most important financial question of 2026. Why does this market refuse to crash, and how long can it actually last? Because the answer isn't what you think. And if you get it wrong, it could cost you everything. Let's be real. If I told you 12 months ago that all of this would happen, 1. The US launched military operations against Iran on February 28, 2026. 2. Oil prices rocketed from 60 cents to over $111 per barrel in under 2 weeks, the fastest oil spike in more than 40 years. 3. Iran closed the Strait of Hormuz. That's 20% of the world's entire oil supply, gone. Overnight. 4. Gas prices jumped 50 cents per gallon in days. Some analysts started throwing around $150 crude oil. 5. Tariff rates jumped from 2% to 12%, the cost absorbed almost entirely by American consumers. 6. The Buffett indicator, Warren Buffett's own favorite crash indicator, reached 217 to 228% of GDP. For context, the dot-com bubble only hit 150%. If I told you all of that was coming, what would you have done? You probably would have pulled your money out, gone to cash, gone to gold, maybe shorted the market, and you would have been wrong. Again, because here's the number that should make your jaw drop. As of April 22, 2026, with a literal war happening, with oil in triple digits, with all-time high valuations, the S&P 500 had fully recovered to its pre-Iran conflict close, from nearly 10% down to completely flat, in 38 days. That's one of the fastest recoveries from a major geopolitical shock in stock market history. So what is going on? Why won't this thing break? The answer comes down to 5 forces. 5 powerful forces that are holding this market up like a force field. And you need to understand every single one. Every single market crash in modern history has had one thing in common. Earnings collapsed. In 2000, dot-com companies had no earnings to collapse. They never had any. In 2008, bank earnings imploded when mortgage assets became worthless. In 2020, COVID destroyed revenue across entire industries overnight. But in 2026, earnings are still growing. S&P 500 companies are projecting 16% earnings growth for this year. 16%. Not a collapse. Not even a slowdown. Actual growth. Confirmed by Bloomberg, FactSet, and S&P Capital IQ. And here's what makes this different from every bubble people keep comparing it to. 75% of S&P 500 companies are showing earnings growth that's broadening beyond just tech. This isn't a one-sector story anymore. When the foundation of the market, corporate profits, stays strong, the house doesn't fall. It's as simple as that. Here's something the crash crowd always forgets. The Federal Reserve is not powerless. After multiple rate cuts in 2024 and 2025, the Fed funds rate currently sits at a target range of 3.50% to 3.75%. That matters enormously because it means the Fed still has room to cut rates further if the economy starts cracking. In 2022 and 2023, the Fed was raising rates aggressively. That's why that bear market lasted 318 days and felt so brutal. The Fed was actively tightening. They had their foot on the brake. Today, the foot is hovering over the gas pedal. Charles Schwab's analysts project 2 to 3 more rate cuts still possible. Analysts at other major firms project even more. And inflation? It's at 2.7% year over year as of December 2025. Still above the 2% target, yes, but coming down. That gives the Fed flexibility. A crash needs panic. Panic needs helplessness. And right now, the Fed is telling the market, we've got tools. We will use them. That's not a guarantee. But it is a psychological floor that prevents the kind of self-reinforcing panic spiral that causes true crashes. Okay, I know what you're thinking. This AI spending looks exactly like the dot-com bubble. And I get it. The numbers are staggering. Mega-cap tech companies poured nearly $300 billion into AI capital expenditures in 2025 alone. Total AI spending is projected to hit $1.6 trillion through 2029. OpenAI is valued at $750 billion, despite losing billions. Those are bubble-level numbers. I won't lie to you, but, and this is the crucial difference, the current AI boom is built on real earnings, not speculation. Look at the actual valuations of the companies driving this market. NVIDIA, trading at 25 times forward earnings. That's not bubble territory for a company growing that fast. Amazon, Alphabet, Microsoft, all trading below 30 times forward earnings while growing revenue at double digits. Compare that to the dot-com era, where companies with zero revenue were trading at infinite price-to-earnings ratios because they had no earnings at all. The 1990s internet bubble was built on page views and promises. This AI build-out is built on data centers, GPU infrastructure, and actual enterprise contracts. Is there risk? Absolutely. Could the AI investment cycle turn? Yes. But right now, the most sophisticated money in the world is making the case that this secular trend has a decade or more to run. And when that's the consensus, markets don't crash. They grind higher. Here's the wild card that most retail investors completely missed. The One Big Beautiful Bill Act, the OBB, passed in 2025, and it quietly became one of the most powerful fiscal stimulus packages in recent memory. Independent analysis from the Joint Committee on Taxation, the Congressional Budget Office, and the Tax Policy Center all agree. The OBB is expected to boost GDP by roughly 0.7 percentage points in 2026, with another significant lift projected for 2027. On top of that, you have private sector business investment absolutely flying. Spending on data centers and computers has surged to record levels, and Charles Schwab analysts expect business investment to remain firm through the end of this year. Now combine that with lower interest rates and you get something remarkable. The economy is actually being stimulated while the market is being tested by geopolitical shocks. The two forces are working against each other, and so far, stimulus is winning. Now, and I want to be honest here, the ABA comes at a cost. The federal debt as a percentage of GDP is on a steeper upward trajectory because of it. That's a long-term risk, a real one. But in 2026, the immediate effect is juice in the economy, and markets price the next 12 months, not the next 12 years. This last force is the most fascinating, and honestly, the most dangerous to misunderstand. Look at the history of market recoveries from major shocks. After the dot-com crash, it took 1,166 days to recover, over 3 years. After the 2008 financial crisis, 1,021 days, almost 3 years. After COVID in 2020, 103 days. After the 2025 tariff shock, 55 days. And now the 2026 Iran conflict? JP Morgan's data as of April 22nd shows the market recovered its pre-conflict close in approximately 38 days. Do you see the pattern? Every crisis, the market recovers faster, not slower. Why? Because every generation of investors has been trained by this pattern. Buy the dip. Trust the recovery. Don't panic. And increasingly, algorithmic trading, passive investing through index funds, and 401k auto contributions mean billions of dollars flow into the market every single month, whether humans feel confident or not. The market has essentially built a self-healing mechanism. Retail investor panic gets absorbed by passive fund inflows. Dips become buying opportunities. And the crash everyone's waiting for keeps not arriving. This is also, and I want you to hear this clearly, one of the most dangerous dynamics possible. Because when everyone learns to buy every dip, the dip that finally doesn't recover will wipe out a generation of investors who forgot that crashes can be real. Now here's where I'm going to be different from every other finance channel you've watched. I'm not going to tell you the market is invincible. It's not, and I'm not going to tell you to be 100% all in. There are real risks on the table right now, and if any of these three triggers hit at the same time, we could see a genuine crash. Not a dip, a real multi-month bear market. Risk under one, earnings collapse. Right now, 16% earnings growth is holding the market up. If oil prices stay at 111 plus long enough to squeeze company profit margins and consumer spending pulls back, earnings estimates will get cut sharply. That's when the valuations at 39.8 CAPE become terrifying, not comfortable. Risk number two, the Fed loses credibility. The Fed's ability to cut rates is the market's safety net. But if inflation surges again, because of oil, because of tariffs, and the Fed is forced to raise rates instead of cut them, that safety net disappears. The 10-year Treasury yield was at 4.29% as of early February. If that climbs significantly higher while earnings disappoint, the math on stock valuations breaks down fast. Risk number three, market concentration unwinds. The top 10 stocks in the S&P 500 now represent over 35% of the entire index's weight. That's actually higher concentration than at the 1929 peak and the 2000 dot-com peak. If two or three of those mega-cap names disappoint on earnings or face regulatory action, the passive index fund world faces something it's never truly been tested on at scale. None of these are predictions, but they are the fault lines, the places where the force field can crack. So you've watched this far, you understand the 5 forces. You understand the risks. The real question is, what do you do with this? Here's my honest framework for navigating this environment in 2026. Step 1. Don't fight the five forces. If earnings are growing, the Fed has room to cut. AI spending is driving productivity gains, fiscal stimulus is flowing, and the market has a self-healing mechanism. Don't bet against the market with your core portfolio. History punishes bears who stay bears too long. Step 2. But protect against the fault lines. This is not a set-and-forget environment. Make sure your portfolio is not 35% concentrated in 10 stocks. If you hold a simple S&P 500 index fund, you are that concentrated, whether you know it or not. Consider diversifying into mid-caps, international markets, or dividend-paying value stocks that aren't priced for perfection. Step 3. Watch the signals, not the headlines. The three things that historically precede a real crash: a sharp spike in high-yield credit spreads, the VIX sustained above 30 for multiple weeks, and earnings estimates getting cut. Not just one quarter, but 2 quarters in a row. Right now, none of those three are flashing red simultaneously. When they do, that's your signal. Not the scary news segment, the data. Step 4. Dollar cost average, not lump sum panic buy or panic sell. The most proven strategy across every market environment in history is consistent, scheduled investment. Not timing. Not prediction. Consistency. Whether the market is up or down this week, your investment schedule stays the same. The market may not crash tomorrow, but it also won't be at these levels forever. Position yourself for both realities, not just the comfortable one. Here's the uncomfortable truth that Wall Street won't say out loud. The stock market doesn't crash because the economy is bad. It crashes when people believe the economy is bad and no one is left to buy. Right now, in April 2026, earnings are holding. The Fed has tools. AI investment is real. Fiscal stimulus is flowing. And 40 years of investors have been trained to buy every single dip. That doesn't make this market safe. But it does explain why it refuses to crash, and why fighting it with fear has cost people more money than actual market crashes ever did. Beat or slower now. The biggest risk in this market isn't the crash everyone's predicting. It's the one nobody sees coming, because everyone's too busy watching the one they're already afraid of. Now, before you go, I want to ask you something. Drop a comment below. Do you think the market crashes in 2026, or does it push to new all-time highs? I'm going to read every single comment and reply to as many as I can. Your take matters, and honestly, some of you in the comments are sharper than analysts I've followed for years. If this video gave you something no one else was willing to say, hit that subscribe button. Because I'm doing deep dives like this every single week. Not the surface level stuff. The real mechanics behind what markets are actually doing and why. And if you want to understand the one indicator I watch more than any other to predict when the market is about to make a major move, that video is right here. Don't sleep on it.